stop scrolling. Because what I'm about to share could change the way you build passive income in Singapore. Singapore investors love one thing. And no, it's not just kopi and kaya toast, it's passive income. And today, we're looking at one of the biggest income machines in Singapore, CapitaLand Integrated Commercial Trust, or CICT. Their half-year results just dropped on the 5th of August, 2025. And trust me, there's plenty to unpack. So if you want more Singaporeans to know about smart investing and not just leave their money in the bank, smash that like button so YouTube shows this to more people. And if you're new here, subscribe to Wealth for You, because every week we break down the numbers so you can grow your income, your investments, and your confidence. Stay until the end, because I'll share whether CICT is a buy or a hold for dividend investors right now. Disclaimer: this video is for educational purposes only and is not financial advice. Please do your own research or speak to a licensed financial advisor before making any investment decisions. Chapter 1. REITs Made Simple. Earning like a landlord without the headache. First, if you're new here, a quick 101. Real estate investment trusts, or REITs, are companies that own income-generating properties like shopping malls, office buildings, or even warehouses. They collect rent minus expenses and then pay most of that income back to us, the unit holders, as dividends. So in short, they do the heavy lifting of being a landlord and we just collect the rent without ever fixing a leaking toilet. Chapter 2. Meet CICT, Singapore's largest commercial REIT. Now, CICT isn't just any REIT. It's the largest commercial REIT in Singapore. Think of them as the big boss of malls and offices, the landlord behind some of the most recognizable places you've probably shopped, dined, or even worked in. Here's their portfolio at a glance. 21 properties in Singapore, including prime names like Plaza Singapura, Bugis Junction, Raffles City, Funan, Westgate, Tampines Mall. And in the fourth quarter of 2024, they made a high-profile move to acquire a 50% stake in ION Orchard, one of Singapore's most iconic luxury malls. 2 premium office properties in Frankfurt, Germany. 3 office assets in Sydney, Australia. Together, these are worth about 25.9 billion Singapore dollars as of end 2024. The portfolio is running at super healthy occupancy, 96.3% overall. Retail is practically bursting at 98.6% occupancy, and even offices are doing well at 94.6% despite global economic headwinds. And here's the kicker. Rental reversions, which is just a fancy way of saying the new rent is higher than the old rent, came in at plus 7.7% for retail and plus 4.8% for office. That's a nice built-in boost to future income without even buying new properties, although in ION Orchard's case, even half an ownership counts as a big win for the portfolio. Chapter 3. CICT's 1H 2025 Financial Performance. So, how did CICT actually do in the first half of 2025? Gross revenue came in at 787.6 million Singapore dollars, down a tiny 0.5% from last year. But here's the thing. Last year's numbers included income from 21 Collier Quay, which they sold in late 2024. If you take that out, revenue is actually up about 1.4%. So it's not that business slowed, it's just that they had one less building contributing rent. Net property income, that's basically rental income after property expenses, was $579.9 million, just 0.4% lower year on year. Again, flat if you adjust for that building sale. This shows the core portfolio is holding steady. Distributable income, the money available to pay unit holders, jumped 12.4% to $411.9 million. 2 big reasons. First, the full half-year contribution from their 50% stake in ION Orchard, and second, lower interest costs, as borrowing rates started to ease and they managed debt well. DPU, or distribution per unit, was 5.62 cents, up 3.5% from last year. At the 30th of June unit price of $2.17, that's about a 5.2% annualized yield. For a large cap, prime asset REIT operating in a high interest rate environment, these are actually solid results. The income growth from Ion Orchard and cost savings on interest more than offset the loss of income from the divested building. Chapter 4. Is CICT undervalued or overpriced? Now, let's put on our value investor hat and ask the golden question. Is CICT a bargain right now, or are we paying top dollar for it? The market cap is around 15.9 billion Singapore dollars, making it not only the largest commercial REIT in Singapore, but also one of the biggest in Asia. Bigger REITs tend to have stronger bargaining power, better access to financing, and more stability in downturns. The PE ratio is about 16.6 times, neither dirt cheap nor expensive for a high-quality REIT. The PB ratio is around 1.05 times. You're paying just a hair above book value, which is fair given they own trophy assets like Raffles City, Plaza Singapura, and half of Ion Orchard. The debt ratio, or aggregate leverage, is 37.9%, well under the MAS limit of 50%, giving them room for upgrades and selective acquisitions without heavy dilution. The ROE, or return on equity, is about 6.3%, healthy for a property trust, showing they're generating good returns from their capital. Put together, CICT is in the Goldilocks zone. Not so cheap that it signals distress, and not so expensive that you're paying an unjustified premium. You're essentially paying a fair price for a premium REIT, the investment equivalent of buying a top-grade Mao Shan Wang durian at a fair market rate. No bargain basement deal, but you know exactly what you're getting. Rich, consistent income and quality that lasts. Chapter 5. Dividend Yield, History and Sustainability. Now let's talk about the part income investors care about most. Dividends. The dividend yield, based on the first half's DPU of 5.62 cents, annualized, that's roughly 11.24 cents a year. At the 30th of June price of $2.17, that works out to a yield of about 5.2%. In today's market, that's comfortably above what you'd get from most fixed deposits or Singapore savings bonds. CICT has been remarkably steady with their dividend history. In 2021, it was 10.4 cents. In 2022, 10.58 cents. In 2023, 10.75 cents. In 2024, 10.88 cents. And for the first half of 2025, 5.62 cents, which puts them on track for another slight increase if the second half holds up. That's slow but consistent growth, a REIT that's clearly committed to maintaining payouts through economic ups and downs. The good news is that these dividends are funded almost entirely from recurring rental operations. The first half of 2025 distributable income came mainly from net property income and contributions from their joint ventures, like the half stake in Ion Orchard. CICT doesn't rely on selling properties to fund dividends. Even when they did sell 21 Collier Quay and the serviced residence portion of Capita Spring, they used the proceeds mainly to reduce debt and strengthen the balance sheet, not to boost payouts artificially. Important dates for the first half 2025 distribution. Ex-dividend date is 12th August 2025, and payment date is 18th of September 2025. Investors need to hold CICT units before the ex-dividend date, which is 12th August 2025, to be entitled to this payout. So as long as their portfolio occupancy stays strong and rental rates remain healthy, this dividend looks sustainable. Yes, interest costs and AEI downtime can affect short-term growth, but for a core income play, CICT is as reliable as they come. Chapter 6. How future Fed rate cuts could boost CICT income. Let's talk about something that could make CICT's future a lot brighter: U.S. interest rates. At the most recent Fed meeting on 30th of July 2025, the U.S. Federal Reserve decided to hold interest rates steady at 4.25 to 4.5%. This was the fifth meeting in a row where they kept rates unchanged. But here's where it gets interesting. Two Fed governors actually wanted to cut rates by 0.25% immediately, saying the job market is showing early signs of softening and tariff-driven inflation might not be as big a problem as feared. Now, Fed Chair Jerome Powell made it clear that the central bank is still cautious. No firm promise was made about when cuts will start, but markets are already betting big. There's now an 85 to 90% chance of a rate cut as early as September, and possibly up to 0.5% in total by year-end. So, what does this mean for CICT? In short, good news. First, lower interest rates mean cheaper debt. CICT has about 8.8 billion Singapore dollars in borrowings, and while 81% is fixed rate, the rest will get cheaper as rates come down. Plus, when it's time to refinance existing loans, they'll likely get better rates, which means less money going to the banks and more money available for unit holders. Second, falling interest rates make REITs more attractive compared to bonds or fixed deposits. When risk-free returns go down, investors start looking for higher-yielding investments. And with CICT offering a 5% plus yield, that makes it stand out even more. Historically, Singapore REITs have seen strong inflows during Fed rate cut cycles. Third, lower rates can push up property valuations. Investors and valuers often use something called a cap rate to value properties. And when interest rates drop, cap rates tend to compress. That means the market value of CICT's assets could get a gentle lift over time, which helps support its unit price. And remember, all of this will be happening while CICT is still enjoying the full-year boost from its 50% stake in Ion Orchard and preparing to open newly upgraded spaces at Lot 1 and Tampines Mall. Combine stronger rental income with lower borrowing costs, and you've got a recipe for a healthier DPU and potentially a stronger unit price. So, while the Fed hasn't pulled the trigger yet, all signs point to rate cuts being on the horizon. And when that happens, CICT is in a great position to ride the wave. Final thoughts: buy or hold? So, is CICT a buy? If you're a Singapore dividend income investor who values stability, I'd say CICT is a solid hold, and maybe even worth topping up if you want to lock in current yields. You're getting 5% plus yield, a portfolio of high-quality, diversified properties, a well-managed balance sheet, and resilient occupancy with steady rental growth. It's not going to double overnight, but that's the point. This is the kind of steady, reliable income play that can anchor your portfolio for the long term. If your goal is to be cash flow rich, having your investments pay you consistently so you can live life on your terms, CICT fits that role very nicely. So, that's CICT's first half 2025 performance in a nutshell. What do you think? Is this still the king of Singapore REITs? Or do you prefer other dividend plays like Mapletree or Keppel REIT? Drop your thoughts in the comments below. If you found this breakdown useful, hit the like button so more Singaporeans can discover smart income investing strategies. And don't forget to subscribe to Wealth for You and press the notification bell so you never miss our latest videos on dividend investing, REITs, and building lasting wealth. Until then, may your dividends be steady, your COPI always strong, and your cash flow always growing.